Hey guys, what's going on? Welcome back to the channel. It's been a few days because I've been working on some year-end planning. And one of the things that I was just working on is my solo 401k. Now, for those that don't know, the solo 401k, if your plan has $250,000 or more in total assets, then you're going to be required to fill out Form 5500, or in your case, since it is a solo 401k, it's going to be the Form 5500 Easy. Now, it's not a really overcomplicated form, really difficult form. It's just letting the IRS know that you have a plan that has $250,000 or more in assets. But the reason that you want to take a look at this is because, first, you can get the money out of the 401k, and I'm going to talk about that in a second, but it is the penalty if you forget to do this that is the real killer. So let me go ahead and pull it up on the screen. So this is the publication 560 that's going to explain everything you need to do with your qualified plans, or a lot of it, not all of it. But this is the reporting requirements for the 5500. And you could see here Form 5500 EZ, a one participant plan, could have just you or your spouse, or if it's a partnership, the partners and also the spouses could be a part of this plan. That is the solo 401k, and that's what I'm talking about in this video. Now, you're going to have to fill out Form 5500 if it's $250,000 or more, but you don't have to do it, as it says right here, Form 5500 EZ not required if your one participant plan or plans has total assets of $250,000 or less at the year end. And that is the key. What is the balance on 12/31 of the year? So if it's not at 250, but it's close, then you might also still want to take a look at getting the money out of the solo 401k, just so you can avoid filing the Form 5500. Now, let me go ahead and show you this page from the IRS. So this is a fix-it guide, but what it's pointing out here is the ridiculous amount of penalties. And this is egregious. The IRS penalty for the late filing was $25 per day. Notice they said was, because up to a maximum of $15,000. For returns required to be filed after December 31st, 2019, which we're already after, the penalty for failure to file is increased to $250 per day, up to $150,000. Now, that is insane. But there is a relief program. Now, the relief program is okay if you find yourself that you didn't want to listen to this video and you wanted to do the 5500, but you forgot, and you want relief. The relief is still going to cost you, because even down here, number 5, pay the required fee. The fee is $500 per delinquent return, up to $1,500 per submission for the same plan. So basically what that means is get the money out of the plan. Now, what am I talking about? You want to take the money, and if it's traditional, roll it into your IRA. If it's on the Roth side, roll it into your Roth IRA and get the total plan assets below $250,000. Don't even get close to it. If you get closer to 200 or less, you'll probably be in a better boat, just in case there's market appreciation or anything like that. Now, kind of thinking about what you would want to do. Should you take the traditional or the Roth side? More than likely, not everyone, is going to want to take it from the Roth side, because if you're going to make a contribution, say a non-deductible contribution into a traditional IRA, and you're going to do that conversion, if you put that money into the traditional side, then you're going to get caught with the pro rata rule. So you want to be careful of that. So if you can, roll the money from the Roth, the solo Roth 401k into the Roth IRA versus the traditional side. Now, if you want to just do the 5500, you can. It's not very complicated. Let me see if I can just pull it up to show you what it looks like. And it's right here. It's really simple. It's just for informational purposes for the IRS, so they can basically track what you're doing. And if you don't want to do that, then just make sure that you are keeping the total plan assets below $250,000 for the total plan. So if you and your spouse add those plans up, and if it's over $250,000, then you're going to have to do the $5,500. But if you want to avoid it, then go ahead and just do a simple rollover. You don't have to do the full amount. You can do any portion that you want. and you can even move positions inside of your retirement plans from the solo 401k into your traditional or your Roth IRA. So that is a very easy thing that you should be able to do. Make sure that you do it before the year end because, like I said, 12/31 is the date that they're going to look at the plan assets, or that you're going to look at the plan assets. So this is a great way to do it. Now, if you're doing Roth conversions, do them now. Get that money over to the Roth side so then you can put it in your Roth IRA. That is the cleanest and easiest way that I can come up with. Now, if you have any questions on this, let me know in the comments down below. And I've hoped this has helped. And if it has, please subscribe and leave your comments down at the bottom.